Welcome to the webinar on cost of production, which is, I think, our third night now, our third Thursday in presentations of our working group models or presentation slide decks, however you want to term it. And they're all a little bit different. Many of you will know there's been a huge amount of work going into these 10 working groups, and this one is no exception. We had several producers who were happy to open their books at different sizes and give us insights that would be very difficult to obtain otherwise. And so this will really help feed into our strategic planning going forward, all of this information. So without further ado, I'm going to hand this over to Neil. You were the chair, I believe, of this group, right, Neil?
No, I ended up doing most of the work on the spreadsheet, but it was a bit of a collaborative effort, and George, consultant, was the one who kept us all on track and on time. So
yes. Well, I'll let you share your screen, and you may or may not be aware there's two parts to this. There's a report and also an Excel spreadsheet that are both available for download off OMSPA.ca. If you go to the tab that says strategic planning and pull that down, you can get in there and download both of these. So you can plug your own numbers into the Excel spreadsheet. So over to you, Neil.
Yeah, and I'm actually going to sort of walk people through a sample of how to use it, but I'm going to start by sharing my screen. And thank everyone for, what's going on here? Oh, there we go.
There you go. Yeah. You
okay. So thank you very much, everyone, for taking some time and showing an interest in the work of what we did with the cost of production model. So tonight, what we're going to look at is, you could call it the business of maple syrup. You know, not to take away from the people who have small operations and make maple syrup for fun in the backyard, or, you know, tap a couple of trees on the recreational property. We also, as part of the strategy, as John was saying, really needed to make sure that we could understand what the economics of running a maple syrup operation look like. The other thing that we wanted to do was to make sure that, you know, we could develop a tool that people could actually use to improve their own operation. And I think you'll see how that plays in. We'll cover who did the work, who worked on this, some of the assumptions. I'll give you a demonstration of how to actually use the spreadsheet. And then we'll cover some of the conclusions that we took away from running some of the samples for the samples in the model. So as I said, you know, why did we do this? Well, fundamentally to understand the economics of syrup production in Ontario. You know, OMSPA has undertaken a pretty significant strategic exercise, and that's going to include, you know, working with potential partners, whether it's OMAFRA or Algonquin College or other other producer organizations. And we need to be able to tell a solid story to people about the economic impact of maple syrup production in Ontario. So, you know, helping understand that, helping members improve their profitability. As you'll see, some of the highlights of running the model are pretty expected. Some of them maybe not so much. And then also, you know, as OMSPA goes to actually execute its strategy, they want to be sure that, you know, the limited money that they're able to put towards that is actually being put to where it's going to have the greatest impact. And so by understanding the key factors that have the most leverage on maple syrup production and its economic impact, the better they can target those resources. So that's why we did the work that we did. Thank you to the people who helped put this together. Steve Duff from OMAFRA, George Horton, and myself Both run relatively small operations. Steve Skinner runs a slightly larger operation, and he's the manager of the CDL distributor in Perth. And Tony Tamori runs a significant operation in Lanark County. Also, Fred Heerkens and Randy Goodfellow from OMSPA participated, and George Brook was the consultant who helped keep us all on time and on target. So these are the people who worked to put the thing together.
Is that Frank Heerkens' brother, Fred?
Frank? Oh yes, I assume so. Sorry about that. Frank, Fred, sorry, Frank. So some of the key assumptions that it's important to remember when you're looking at using this cost of production model. First and foremost is there is no right answer. So it is not possible to use this and say, if I tap 2,000 trees, how much money will I make? As I was saying to John Williams, it's kind of like, how long is a piece of string? There's no answer to that. The better way of looking at this cost of production model is in fact to use it to compare the impacts of variables. And I'll show you how that works. What happens if you keep everything the same and you increase your yield from 1 liter a tap to 1.2 liters a tap? Those are the sorts of things that the model is particularly well suited for. In putting it together, we designed it to keep data entry very simple. So as you'll see, there's a lot of flexibility in how you use the information that you're able to put together and put into the model. But in keeping with that, we use very few preset values because we wanted to make sure that it was as flexible as possible to be able to accommodate really the myriad of different ways that people run their sugar operations. A couple of important points. So again, I want to keep emphasizing there's no single right answer. We did use, as you will see at the conclusion, we did use the model to try and kind of center in on a couple of key questions. But for the most part, use the information that you have. And if you don't know the expense of something or what the hourly rate that you pay someone is going to be, use your best information, use your best guess if that's what you need to. If you have 4 people and you pay them all a different amount of money, average out the salary and just put the one figure in. As you'll see, it's more about the comparative values. In the same vein, the expense categories that are in the model are really their guides only. So if it says, enter the amount of money you use to, repair and maintain your taps, and then on the next tab, there's enter the amount of money you put in to maintain and repair your equipment, and you have it all bundled up into a single number, I'll just put the single number into one slot or the other, or divide it somehow. The important part is just to make sure that all of your expenses get into the model somewhere. That said, as you'll see once you run through this, it is important to be able to separate out your labor costs, whether it's a bundled number or not, your capital costs and financing costs, interest or bank loans or things like that. I mentioned previously, we have very few preset values. A big question is what to do about the land if you own the land that you're tapping. And so what we decided to do was if you own the land, it's a part of your sugar operation. But so the cost of acquiring it, holding it, so if you have a mortgage, your property taxes, those are costs part of your operation. But we decided to exclude the appreciation of land. So, speculating in a sugar bush can be a lucrative business in and of itself, but it's not really within the framework that we're looking here. So if your business model includes a line for the appreciation of the value that you're running your operation on, that's not going to fit into this model. And in the report that John was saying you can download from the website, there's a lot more details on how to use the model. So If you missed something in the presentation tonight, don't worry. The model itself has some pretty good explanations, and the report itself also has a number of sections on explaining how to enter the information. Okay, so having said that, I'm just going to switch my screen. Give me 1 second here. I have to do this, turn one off and then turn the next one on. Okay, can everyone see the Excel spreadsheet, the model itself? So what I've done is I've gone through and I've sort of pre-loaded this.
Yeah, my speaker's not working.
Sorry?
Oh, sorry, Bill, I'm going to mute you. Just didn't realize he was unmuted.
Oh, okay. So I went through and put some numbers in for a mythical 3,000 tap operation. A lot of the numbers are made up, so please, don't point out that there's no way you can do annual maintenance for $750. I just put a number in there so that we could see how it all comes together. Key point of this model is anywhere that there's a green cell, that's a place for you to do data entry. It's expecting you to put some kind of information in there. Anything that's in blue is a number that's calculated elsewhere. So please don't go and change those. The model is actually is protected, but not password protected. So if you actually are experienced with Excel, you can go in, you can remove the protection, and you can have at the model. We have no intellectual property rights over this. Just don't call it an OMSPA model if you've gone and modified it, please. So there are 5 tabs of information, and as you'll see, it's all pretty straightforward. One to do with Sap Production, one with syrup production, one with selling. There's one for capital costs, and the income statement is where we bring everything together. So I'm actually somewhat counterintuitively going to start with the income statement, because that's where you can see there's a couple of green sections here where we want to enter some information that helps to guide you for the other tabs. So as I said, we have a 3,000 tap operation. 1,000 of those are rented from the property next door. We spend a fair amount of time, and we have an average yield of about 95%. So we get 0.95 liters of syrup for every tap that we put in a tree. If you're wondering why the syrup produced is as high as it is, it's because, as you'll see under Sap Production, I also in the model have put an assumption that we buy some sap from a second neighbor down the road. So we'll come to that. Of the syrup that we sell about 20% retail to friends and family, and a little bit of farmers market work in the spring and the fall. But we have a good arrangement with the local grocery store, takes a lot of the syrup and sells it for us. So that's the sales model that this example uses. But you can change these to anything you want. The model won't let you put in numbers that don't add up to 100. So you have to be sure to put in a split for your sales that comes up to 100%. These 2 labor rates, this is what I was saying. We've only allowed, place for one single labor rate for outside labor. So that's anybody that you're paying outside your business, your family, however you define ownership. And then there's the amount of money that, you would like to pay yourself. And as you'll see as we go through this, being able to at least account for paying yourself is an important part of running this model. So these are 2 numbers that we got from some of our inputs. to fit sort of regular wages in the region that they operate in. Use the numbers that apply to your particular operation. If you can get away with hiring a lot of high schools, teenagers, your outside labor is going to be lower. Yeah, so whatever is true to your particular operation. So then let's go back to the SAP, the first tab, the Sap Production tab. You'll see some of these areas are just, it's just for information, so that when you're looking at the whole thing, you can understand, you know, how the system is put together. You can see here is a blue tab, which means that we're not supposed to change it. And if in fact I try and change it, you'll see that I'm trying to change a protected sheet. So it doesn't let you change any of the blue values unless you know what you're doing. So we have 3,000 taps, and of those, 1,000 are rented. This is our yield. Average SAP bricks. This is more for those who want to try and refine things a little bit. We usually just keep it at 2. So on the taps that we own and we rent, I assume that we spend about $750 a year in the pre-season to fix and repair drops that have been chewed through and so on. Because we're renting taps and trucking SAP, we have to put some money aside for covering that. And we pay our neighbor $1.10 for every tap that we put in the tree. Labor, this is one that you need to think about a little bit, because we went through a number of different permutations of how to enter this information. So you'll note this is labor in person months, assuming 20 days a month. So what this little piece means is that I've assumed that to tap all the trees, get everything organized, clean the equipment, get the camp ready to run, I would need one person working for 20 days and myself working for 20 days to do all that work. And now you can enter half days if you like, you know, so that's the equivalent of 10 days. It really, you know, again, is depending on how you run your operation. And then based on the salary numbers that you entered previously, this calculates a dollar value of the cost of that. We pay property taxes, and then we also pay a certain amount every year because we borrowed money to buy the land that we tap. As I said, there's also an ability to accommodate simply buying SAP, which is another way that some producers source their SAP. And again, you know, there was a lot of questions of how best to put this number in. You know, should we put in taps? And then we had to do the yield again. So in the end, we decided that most people who do this, they buy a certain number of liters of SAP. And you can sort of work your way around, because you can see here, based on the average bricks that you entered up here, okay, and the cost of the SAP, based on the bricks rather, and the amount of SAP that you're purchasing, we've sort of calculated the amount of syrup that you would produce. So, you know, you can sort of work that backwards if you have a number of taps and a certain yield that you want. So, you know, assume you had 1,000 taps and you got a 1.1 yield. Well, then you could just adjust this $50,000 number, 50,000 number, until you got the right number of syrup. So it's a bit of a bear, but as I said, you know, we tried looking at this a couple of different ways. And for the people who actually do buy SAP only, they buy it in terms of liters of SAP. So that's what we thought we would do. So this is all the data entry that you need for your setup, for, you know, getting SAP as far as the edge of your sugar house. Then we go to the next tab, which is production. And here you can see a lot of the information is already calculated for you. You know, if we're doing 3,000 taps and we're getting, you know, a certain amount that were produced and a certain amount, this is our 0.95. This is the syrup produced from purchased sap. So this is the total amount of syrup that we're producing. And you'll recall that we were going to do 20% of that retail and 80% of that wholesale. So 20% of 39.55 works its way into the sales piece, as you'll see on the next page. Excuse me. Again, your equipment, this is just for reference. This information is not used anywhere in a calculation. Amount of sap processed is also not used. It's just for reference. So the information that you do need to enter with regard to production is your bottling costs. And we allow you to change, your bottling costs from wholesale to resale, or between wholesale and retail, depending on size of containers and whether you're bottling it yourself or not. There's amount in here for electricity and fuel. And you'll notice that these are all per liter of syrup. So if you have I spent $5,000 on heating oil and diesel fuel last year, you'll have to divide that number by 39.55 and enter it in here. So there is a little bit of manipulation. And once again, I just want to repeat, we looked at putting in bulk single numbers, but this was the way that, most of the people that we worked with preferred putting in the information because it was, it was more relevant to them. Spot here for other costs. This is not per liter. This is just fixed. So this is kind of the catch-all. If you decide that you don't want to try and figure out what your per liter costs, but that, in the end, you spent $5,000 on all of your production, you can just enter zeros here and put 5,000 in here and call it a day. So, there are different ways of entering information into the model. And similarly, you could split other costs in production and maintenance, or you could just put it all in here. This is the point I was saying. The important part is less which particular cell you put the information in, and more making sure that you get your total costs correct. Here again, we have the same sort of calculation. This time it's, how much labor do you need to actually run your production for the season? And in my mythical little model here, I have 2 people working for 20 days in a month that we're actually boiling, a little bit of carryover, someday somebody's off. This is the total that I figure I would need to pay. And, I'm there for the 20 days that we actually are boiling because we don't boil every day in our model. And you can see here, I set the building mortgage to 0 because, we own the building. We're just paying a note on the land. So again, we tried to keep the number of data entry points down so that, you didn't have to, calculate value of drill bits per tap and all of those sorts of things, but still allowing people flexibility to enter the information depending on how they keep their books. The next one is sales. Here, what you need to put in is the average revenue per liter for retail products and for wholesale products and for bulk products. These are just sample numbers. I noted in the Globe and Mail today, I don't know if people saw the story about the Quebec producer that was bought by Bain Capital, which is a major investment bank in the US for, they estimate $100 million. But one of the points I thought that was interesting was he said that they were getting $1,950 for a 45-gallon drum, which by my math is almost $11 a liter for bulk syrup. So
we appreciate that often people sell it in pounds, but there was a decision to make it all in liters because people sell wholesale and retail in liters, and so we just wanted to keep liters there calculation.
That's a good point. I guess in a future version, we could, put a little calculator off to the side to let people convert from pounds to liters if they wanted to. Then down here in the actual selling expenses, you know, in our little model, we have transportation, storage, direct sales cost is invoicing, and you know, some of the pieces that go with renting a table at a farmer's market for a morning, whatever your actual sales costs might be. And in this model, you know, I don't hire any outside labor. I do all the selling myself because I love to get out on Saturday mornings and chat with people and see who I'm selling to. So those are the three main pieces, kind of divided along the three main elements of, you know, producing sap, producing syrup, and then selling it. We have a capital cost section. And here again, I would emphasize that if you know, we put all of these different components in here, partially because we had a number of producers that gave us very specific information. And so for us to calculate the totals, we needed to break it down. But at the same time, you don't have to do it that way. If you can see here in my model, I just decided that I added up all my receipts and I'd spend $125,000 on equipment. The important point to note is this element here, the depreciation term, because as you'll see once we get to the income statement, understanding how your capital costs depreciate every year is very important. So we just use a straight line depreciation. So if you change this to 10 years, you'll notice the depreciation cost goes up because you have to allow for a greater component of this 125 over a shorter period of time. But you know, in keeping with use the information you have in the format you have it, you can see we have a number of different samples here. And down here, we actually put some money in for the sugar camp and fit up. The piece down here that I thought was interesting is the cost per tap. This is the amount of my mythical operation. But you can see here that, you know, these are actual numbers from people who helped us with their real information. And, you know, one of the points that we're going to come to, 1,400, 6,000, and 38,000 taps. $70 a tap, $33 a tap, $22 a tap. There is absolutely an economy of scale that goes with this business. Not surprising, I'm sure, to many, but this, you know, helps you to get a first little insight into what those economies might be.
So these are actual figures from those three different producers of those three different sizes?
Yes, exactly. And this green sample is ones that I just made up for tonight's demonstration. So having entered all of our information, we have one last step to go, and that's in the model. And you'll see here on the income statement, there are actually some pieces that are in green. And so this is a place for you to enter some of your overhead information. You'll see here that, you know, repairs and supplies, tap rental, these are all coming from the other tabs. But here is a place for you to enter stuff that doesn't really directly impact production of sap or syrup, but are costs nonetheless that, you know, have to be incorporated and allowed for. So I just put some numbers in here for advertising, legal, accounting, insurance. I can write off some of my home office, so I put some numbers in there. And so we put all the numbers together, and what do we see? Well, you can see that based on just under 4,000 liters of syrup, of which we're selling 20% retail at $25 and 80% at whatever the number was. What did I say? $14.50?
$15. Okay.
So, you know, our little operation makes just over $65,000 a year. And
that's at 0.9 liters per tap. Yes.
Yes, exactly. 0.95 liters per tap. And you can see here that, you know, the cost of goods, the bottles and shipping freights and so on, is $21,000. So that leaves us 44. And then our overhead, the stuff that doesn't vary by volume, you know, your insurance is what your insurance is, whether you produce 2,000 liters or 5,000 liters. So your overhead costs, which are sometimes people call them your fixed costs, they're 26,000. So the profitability of this venture, as it's shown here, $17,000 at 27%. Not bad. You can see here our large operation. So again, these two sets of numbers are actual figures taken from producers who opened their books to us.
Neil, you haven't calculated interest and carrying costs and depreciation costs. Right?
I know that's the next part of my presentation.
Sorry,
because I wanted to, you know, as we have discussed, people often don't include those and think, look at all the money I'm making, and you know, look at all the money this large producer is making. You know, 38,000 taps, and he's running, you know, 40% operating margin. He's making $200,000 a year. Even our little 1,400 tap operation, you know, is running at 68%. It's got $20,000. It's perfect. But up here, you'll notice that we have a couple of switches, and you can vary these because they are in green. And what it does is it allows you to decide whether or not you want to include these costs in the total. So you'll notice that carrying costs, which are the financing and interest costs, I've set to no. Depreciation, I've set to no, and owner's labor, I've set to no, but outside labor, I've set to yes. So when we, you know, when we come down here, you can see outside labor, we have a value of $13,000. So that's been included in the cost. What happens if we change the first two to yes? So we include financing and depreciation. Well, the first thing is that all of a sudden our great money-making venture basically breaks even. Now, you know, this is something that can be particularly problematic, is the depreciation cost, because this is not, you know, you don't write a $12,000 check to anyone for this money. But if you, you know, spend $125,000 on your equipment and just use it every year, use it every year, use it every year, 10 or 15 years, all of a sudden you're writing another $125,000 check. And where's that money going to come from? So what depreciation does is it forces you to account for the fact that eventually you have to replace your capital equipment. And this is why it's important to include that. Similarly, carrying and interest and carrying costs, you know, if you have a specific loan tied to your equipment, then, you know, maybe it shows up in your operations. But if not, it's often easy to forget land costs and only focus on the money, the checks that you write to make syrup. So having included those, you know, our large producer is still doing pretty well, you know, is making $100,000, running at a 20% margin. The small producer, even better, but, you know, they're running a much skinnier set of expenses. And part of that is reflected in the fact that their yield is 0.7 versus a yield of 1.15. So, you know, it goes both ways. The last switch that you have here is owner's labor. And this one you can include or not. It depends on how you want to use the model. Because if you have incorporated your camp as a business and, you know, you've included all of these things, then the previous EBITDA, you know, not counting depreciation, is money that you can, you know, choose to pay yourself or not. And if you don't want to write yourself a check, but you want to take dividends, you know, there are lots of ways as an owner for you to take money out of out of a company. So this is why we leave people the flexibility to turn these particular values on or off. But it's important to know what it is. You know, we figured that we're worth $50 an hour, and we estimated how much time we would spend on this operation. So let's just go and see what happens if we actually, you know, had to pay ourselves. And you can see that, you know, we're now in the hole for $30,000. So the converse, the other way of looking at that is that, you know, I'm going to have to give up some other job if this is a part-time operation that pays less than $30,000 in order to make this worthwhile. You can see over here, our large operation is making a smaller margin, but the owner is making more than enough to pay himself a decent salary for a whole year. And now all of a sudden, our small operation that was making such great margins, once we include the owner's time, also loses money. So 2 points here to take away, and we'll return to some of these when I finish off the presentation, is economies of scale and yield. And so just to show you how the model can work to your advantage, as I said, the model is best for doing comparatives. And a good way of doing a comparative is to answer what if questions. So this is what we know this system looks like. So what if we invest a little bit of money or otherwise just spent a little bit of extra time and got our yield up to 1.2 as opposed to 0.95? What happens to our operation? Well, you can see we've made 10,000 extra dollars, and we almost break even on a cash flow basis by increasing our yield. John was saying he's not happy unless he's up at 1.5. If this was John's operation, he would definitely be making positive cash flow, and before depreciation would almost also be breaking even. So these are some of the things that you can do. Another thing you could say is, well, what if I did in fact hire some high school students to work for us? I think minimum wage is close to $15 an hour now. So we come and we change this. That also impacts the bottom line. Now we truly are almost breaking even. So there's a lot of what if that you can do between the switches, between the taps. What if we didn't rent taps, but own them all? What does that do to our, well, clearly we make more money when we own the tap as opposed to renting it, which sort of intuitively makes sense, but you can see it doesn't make that much of a difference, because when you own the taps, then you have the costs that are associated with keeping care of them. So,
Neil,
yeah.
Do you have any thoughts on how to work in if you're doing maple products too?
So yeah, what you can do is here use the average of all your retail products. So if you let's say so you see here from the income statement we have 1,000 liters that we're selling retail. So if how much of your syrup goes to making sugar or maple butter or something like that, that's a bit of a harder question to ask. But what you can do is maybe work backwards from if you know how much your syrup you're going to produce every year and you sell X amount of it wholesale, then how much money in total do you make from what's left, and divide that by the 1,121 that is used in the model. I don't know if that's clear to people.
Well, I know some people say that they want to make $50 per liter of syrup they've made by adding value to it.
Yeah.
And
so if you happen to know that number, then yeah, absolutely. So let's say that we're going to take a little bit of extra time, or we in the process we can make some butter and syrup or sugar and so on, and to use Randy's number, let's say that we can pull off $50 from the retail side of our operation. When we come to the income statement, now we're making a lot more money, and that flows right down to the bottom line.
Does it account for the extra time that it takes to make all those products?
Well, you could do that. You could do that by coming here and saying, how much extra time are you gonna, put in? Let's say, an extra half month for help and an extra month for your own time. And, you know, the profit goes down, but clearly you're still, you know, ahead by having spent the time to make those products. If you can,
and you might have a little extra equipment that would push your equipment costs up a bit. But yeah, you could work all those
well,
things.
and you know, so it's as easy as going, yeah, so I'm going to, you know, I'm going to, I don't know, there was somewhere here.
Well, you've got a blank one there, number 28. You could probably stick it in.
Yeah, absolutely.
It's non-specified.
Yeah. So, oops. Oh, it doesn't let you put the change in. So, I mean, you know, what you can do is just, you know, rename one of these and then just put in, you know, spend $7,500 on equipment to make maple sugar, because you'll see that capital costs have a relatively small impact on the income statement, which is the piece that we're talking about here. So, but this is why we tried to keep the number of entries small, so that, you know, if you go, well, so what happens if I do this? Oh, I'll have to buy some equipment, have to spend a little bit of extra time. You don't have to do 100 calculations and then put the data in. Just go in there and you know, play around a little bit. And as I said, the key takeaway is to note the change of the bottom line, or the change in any particular percentage, or, you know, the change in your takeaway, your owner's labor. Those are it's the relative comparison of these two. You know, even something as, so let's, you know, let's do something different. So go back to $25, because we're just, you know, let's assume we're just selling retail. But, you know, instead we're really going to put a push on, and we're going to spend more time at the farmers market. So we're going to, you know, rent a lot more tables, and, you know, we're going to spend extra time selling. But that's going to mean that we'll spend, you know, we'll sell 35% as opposed to 20. What does that do? Well, you know, it changes. We're still running at a bit of a loss, but certainly, you know, things are looking much better. So spending time on retail, how much do we need to sell retail to break even? No, about 45%. You know, so this is how the model was meant to be used, to, you know, sit here, what happens if, and then for you to just take note of, you know, either the percentage, that's why the percentages are here. How much does my labor change as a percentage? Or how much does the bottom line change as a percentage, or change as an absolute value if I double the amount of retail or increase the yield or things like that?
Part of the reason, Neil, for actually breaking it out this way was that there's a lot of people say, oh, yeah, I'm making money, but they don't count for their, and then some people will then say in brackets, if I didn't count for my labor and my depreciation. This is show what happens if you include your labor and your depreciation, for those reasons that one might want to do that. I.e., to know how much you got to put aside every year to be able to re-afford the replacement, or you need to know that in 10, 15 years, you're going to have to go back in and borrow that all again.
Exactly.
So, yeah,
exactly.
So that's why it's called a labor of love.
So my plan now is to go back to the PowerPoint to finish off by covering some of the takeaways we found in using the model. But before I do that, does anyone have any particular questions on using the model itself, or suggestions that we might make it easier, better to use? Just while I have it up, now's I think a good chance for people to raise their hand, and I'll let John moderate any questions that people might have on the actual model and the spreadsheet itself.
Or if you want, type in the chat, whatever works for you.
Probably the best feedback we're going to get, though, Neil, is after people played with it themselves. They won't know if something's difficult or or easy, or where they might be tripping up and not understanding things. It's play with it, I guess, is the best way.
That's fair enough. Okay, there is one. How does the bulk model work? So that I can show. So the bulk model works the same way. So you know, let's assume that you wanted to make life easy and you're just going to put your syrup in barrels and sell it to whoever would take it. So you change your percentage of sales to 100% bulk. You come here to the bulk section. You'll notice now that the model shows 0 liters of retail, 0 liters of wholesale, and the whole amount as bulk sales as your output. Put in what you think you can sell it for. Your direct sales costs realistically are going to be minimal. Your other sales costs are going to be minimal.
Probably your transportation and storage are as well.
Yeah, you know, well, it's depending on when you get the barrels picked up, but sure, let's lower that a little bit. Just checking, these don't apply because they're not wholesale or retail. Fuel, all that stays the same. Labor for maybe for production, because you're not making sugar, you're just you know, running it. Let's do it that way. And so what happens? Well, you know, now you can see the bulk revenues are $50,000. Costs have gone down. Operation still loses money, but it's pretty much losing exactly the amount that you're paying yourself. So this operation with a 1.5 liter per tap yield would, you know, cover itself, cover interest, cover depreciation, but not leave you money to cover your time. So, you know, you would need to find a different way, and you know, maybe some of your fixed costs in here can go down. Maybe there's something on the SAP side, you know, that you could use. But that's how, you know, this is another example of how you could use this model to answer a question like the one that we had from oh, there's another one. What's your break-even tap count? Okay, so the break-even tap count. So let's go back and assume, what do we want to do? 25, 75, 0 maybe. Let's assume that we have 3,000 taps, 1.5 liters as our yield. These are the costs. Because we put our bottling costs and our retail costs on a per liter basis, then that lets us simply go up here and say, okay, with these fixed costs and, you know, these variable costs, how many taps do we need to, well, so this is already breaking even. We need to, you know, come up with some other costs. Oh, we have to put the sales costs back in. That's what I'm sure is. And just to sort of keep it realistic. How about that? Just, you know, just so that, you know, geez, I can't make this thing lose money. How about that?
Well, yeah, you can, because you just reduce the number of taps slightly.
Yeah.
That's another way of reducing it too, to get your break even.
So what happens if we go down to 2,800? Well, that's pretty close, you know, maybe 2,850. So you can just kind of play with it this way until, you know, this number comes to 0. So again, another way of working your.
Yeah, well, that's 2,850 taps in total, of which 1,000 are rented. Is that what you're saying?
Yes, yeah. So these two are not added together. This is the 1,000 is a portion of the 2,850.
Yeah, and so that probably shouldn't surprise people massively, because a lot of people say, you know, if you ask them, what's the break-even number of taps? Of course, we can say, oh, it all depends. It all depends. It all depends on your labor rate. It all depends on your yield per tap, et cetera, et cetera. Oh, it's the University of Vermont studies say it's about 3,000 taps. Other people would say, no, maybe it's 27, whatever. It's so that we can actually have a conversation in a sense based upon similar understanding of what's included and not included.
Yeah. And this break-even number includes, you know, some money for the owner. So it's a realistic number, let's call it that. Okay, let's, because we're coming up on 8:30, let's go back to the, okay, so what were the things that we found? So we did some of these what if questions. So in addition to producing the model, we did some looking into, you know, which are the factors that have the biggest leverage, excuse me, on the profitability of an operation. And by far the winner was yield. You know, the saying somebody told me was, you make your money in the bush. And so if you have more sap, you get more syrup, and everything flows from that. So certainly, if you have money to spend, this model would seem to imply that, you know, it's best spent on improving your yield, whatever that looks like. As I pointed out in some of the examples, there are economies of scale. Size matters, and, you know, anecdotally from the producer on our team who you know, was running over 35,000 taps. You know, he said, look, I can afford to hire people to go out and pull lines tight and make sure they're not drooping and check for leaks regularly, as opposed to once at the beginning of the season and at the end of the season when we take it down and find that, you know, this whole line has been leaking for, you know, all 4 weeks that we thought it was producing sap. Having the size to invest in yield and having the size to invest in some of the equipment like ROs and so on that, you know, make your syrup production more efficient matters. Again, not surprisingly, maximizing retail sales is a way to maximizing the profitability of your operation. But we were also cognizant of retail sales don't just happen. You know, if you are, and by retail sales, we mean the producer is actually the person collecting the $25 for the liter of syrup or whatever it is you're selling it for. So what that means is that you either are going out and delivering on, you know, evenings and weekends to friends and family, you're spending your time at the local fairs, you are, you know, running a store on your property while the camp is open. You know, there are costs involved with retail sales that you have to be sure you're accurately reflecting in your model. And then the last one that, you know, Randy pointed out, I'll point out again, beware of all your costs, because if you're not counting depreciation, not counting your own labor, not counting finance costs, then you really aren't necessarily projecting a true economic picture of what your business is like. And not to say that that's wrong, you know, like it's completely acceptable if you know, you don't really want to look at that, you don't want to know, as long as I get enough money to cover the checks I write for bottles and fuel, I'm happy, that's good. But, you know, part of this exercise was so that people could, you know, have something that they could go to investors with to say, I would like to borrow $50,000 to invest in scaling up my operation. And, you know, any bankers, the first question is going to be, well, what's that going to look like? Now, at least there's something that they can use to answer that question. So the other question, you know, that inevitably comes up, and this is, I admit, a bit of a single point answer that I cautioned against, but we did it over a range. And, you know, we said, so how big do you need to be implying how need you be to break even, to make money. Well, how much money do you need to make? You know, full-time owner, are you happy making 55,000? Do you want to make 90,000? Part-time owner, you know, how much can you afford to drop if you have a job that lets you take time off in the spring? How much money you're going to lose there? How much money do you need to make to compensate for the lost wages?
Or the other way, look at what is the other job that can fulfill your living requirements above 50 to 30,000. Yeah.
Exactly. So, you know, but these were the assumptions that we used. Clearly, as detailed in the report, if you're looking for full-time, then you really need to be looking at a yield of about 1.5 or higher, because otherwise, you know, it's really hard to justify even the lower salary. And all of our sales, the break-even points, the models assume significant retail sales and a modest owner salary.
I think also, Neil, there was some consideration about how much retail sales any one operator could do. So you may have 38,000 taps, as is the case of one of the real live cases that we put here, but they could only amount a certain amount of effort towards retail sales. So there seems to be trying to push retail sales past a certain point is extremely difficult.
Yeah, exactly. And so in the part-time model, and this is detailed in the documentation, but so in these models, we maxed out the retail sales at about 2,000 liters a year. So if you have 3,000 taps, we assume 2,000 of that was retail and the rest was either wholesale or bulk. So you can see here, you know, for the part-time running a smaller operation, depending on the yield, you know, your break-even point could be as high as 1.2, or it could be, you know, all the way down at a little bit under 1. But you know, that's for a relatively modest net income, remembering that this is after you've paid yourself. So this is, if you sort of run across, you're running 1.2, you know, you can break even on 1,500 taps, but that includes paying yourself. I think we put about $20,000 in for that one. And then for full-time, we sort of did the same thing. And again, you can see here, you know, because you're talking bigger numbers, you really need to have, you know, a better yield. But with those bigger numbers, then your profitability jumps up pretty quick. So, you know, if you have 20,000 taps and you're only running a 1.5, then you're kind of breaking even, although you are paying yourself a salary. And so this is net income after an owner's salary. But you know, adding a doubling, you know, essentially doubling the number of taps, and now you're closing in on $200,000 after you've paid yourself. So
with depreciation in there.
Sorry,
with depreciation included.
Yeah, this is all the other costs are in there. Absolutely.
Yeah.
So this just goes to show, you know, the economies of scale. You know, you're sort of breaking even, double it, and you're going to 200,000, double it, and you're up to 500,000. So the, you know, your income increases disproportionately to your yield when you have a lot of taps. There are a couple more of these diagrams, and in the model itself, there's a tab with the figures that went into all of these. If you want to dive in and get a little bit more, run them yourself. But otherwise, that is what I wanted to talk about for tonight. As I said, there's two, as John pointed out, there's two documents. There's the report that we wrote, and there's the actual Excel spreadsheet that I just walked you through. Download both of those from the website and play around with them. They're free for you to use as you wish. Otherwise, are there any questions?
Well done, Neil.
There's something
very well done. And this will be a useful tool for just about anything. I just went over my figures quickly while you were doing all this, and yeah, I guess I made money last year.
Well, there you go. How about your brother Fred? How did his operation work out?
Mind you, I only paid myself $1 an hour.
Yeah. This is what happens when you do things too much at the last minute and don't get someone to check it on you. So there we go.
So Neil, any chances of I'm looking at this, so I don't know what the outcome of your group, what you'll be doing or something, but you know what would be interesting is to have this tool on our website that people can use.
It
is. It is.
Yes.
It's there for you to download, so you can't sort of just go to the website and enter the information. That, I mean, that might be something to think about. Certainly one of the other pieces that, so this was meant to be a living document. So, we'll put it out there, people will use it. They'll, give us some feedback about what works and doesn't work. But another key element that's going to feed into this is there's another working group that's looking on data, because for example, as you saw while we were playing around here, yield plays a huge factor in the viability of an operation. So if you're using this to go to the bank to try and get a loan to expand your operation, and you say, oh, I'm going to run a yield of 1.5, and the banker goes, well, how do I know that? I don't know much about maple syrup, but I know that it's the tree that determines that as much as you. So, what's it going to be next year? How do I know that you're going to be able to keep that up? The data group is looking both historically, regionally, at a bunch of different pieces like this, so that, we will have some series of data points that we can use to populate the model to do different kind of work with it. So, there are actually two pieces that are coming together on this that I think are going to be, make for a really powerful argument about, at the end of the day, what's the economic impact of the maple syrup industry in Ontario? Well, there's nothing to prevent you from using the model and putting in 500,000 taps or 2 million taps. You might have to broaden the columns to fit the numbers, but it all still works equally well. And so possible future uses of this. But to start with, I'd encourage people to just download the spreadsheet, play around with it, feed your comments or questions back through John is probably the best way to do that. He'll know where to find me. And I anticipate, in the not too distant future, we'll be coming out with version 2, bigger, better, bolder than the one that we have here today.
There's a word that people use called evergreen. And that's, I guess, what Neil was saying. The data that will be collected by the efforts of the data group, which will be an ongoing effort, will feed in here. Because darn well, we know that if you're in glass bottles last year and your glass bottles this year, it costs a heck of a lot more this year. And so that will have an impact. And so we just need to stay on top of those things. And I think, as you mentioned, Neil, the chief economist of OMSPA helped with both the data group and with this cost production group too.
Yeah, that was Steve Duff.
Yeah, Steve Duff.
He was a real big help to us for sure.
Yeah.
So a question, John, where I didn't check right now, where is the tool? Is it into the, where exactly on the OMSPA.ca?
It's OMSPA.ca and the strategic plan tab, and pull that down. And then there'll be an option for working group reports. And then you just click there, and then you'll see, I don't know whether, actually I could share it. I could go in and share it.
There may be a better place to place it ultimately, and it can be found more easily, but right now it's under the whole work of the, housed under the work of the steering of the strategic plan. But we may put it, where it's easier to connect later.
It's pretty easy right now.
Yeah, it is. It is. Randall, you made a good point there on both the glass from last year and the glass to this year. And if you were to calculate using that model, you could be able to calculate what your costs were last year and calculate the cost for this year to make your decision whether you should raise your per liter price to from 22 to 26 or 25 or whatever it is, and give you a little better understanding of where you're going to make money.
Yeah, the folks are selling it for $18. Wow, I don't know how much you're losing every year. Let's put it that way. We actually put 25 in because that's what we're getting this year. So, but then we have an Ottawa marketplace. Not everybody has that benefit, but if you just say, well, I've always charged 18, you should ask yourself, have you made any money? And you can find that out by doing this.
I know Bill's on the line here, and I know, Bill, you were talking about the price that was last year, but don't feel bad. In Castleman here, there was some of them selling for $15.
Still?
Liter?
Yeah,
Still,
$15 a liter.
Oh my God.
Where did you see that in newspaper? I know last year, same guy, Frank?
Yeah, same guy, yeah.
No, seriously?
Well, Claude mentioned it last night.
Yeah.
Oh, is it Claude that mentioned it? Okay, I was not listening to him. Okay. Oh, that's bad.
Yep.
Anyway, but it
just
also gives us an opportunity to have discussions on the same basis. And if you look at it from a longer term sustainability perspective, and I don't mean environmental sustainability, that all fits everything, but economic sustainability for a healthy industry moving forward. And when we go to want to sell our places to other people, they have to be, as we say in French, rentable, which is feasible. They have to be economically feasible to be able to handle the cost of the purchase. And so we're going to get a little sharper with our numbers here. Now, I know there's a number of us saying, oh, well, it pays for every year. Maybe I'm not covering my labor. But my goodness, my sugar bush went up threefold in the last 5 years through appreciation through real estate. Yeah, that calms my nerves a little bit and keeps my wife off my back. But, is it truly
at least about the
sustainable
camp.
economically? Hey?
At least about the camp.
Yeah. Anyways, we have to get serious about this type of stuff if there's going to be an industry over an extended period of time, at any, that can meet the market, increasing market demands.
So Neil, if I'm looking, I was trying to look for not tax evasion, but whenever you do your income tax, you can get some nice rebates of being a farmer, and also the capital gains costs that could drop down. Was that embedded in here, or is that like something we have to think after the fact?
That's something you have to think after the fact, because like we included taxes that are a cost, so property taxes and things like that. But we didn't include anything on HST because that's really meant to be an in and an out. And things like, tax rebates, personal income taxes, the directions that can go just spread so far, so quickly that, and it's really, it's more a personal decision. Even the fact of including labor, included or not, you can pay yourself a salary and pay taxes and EI and CPP, or you can pay yourself a dividend and skip that. And the amount that the check you cut to the government is significantly lower. So no, we didn't include any of the tax or other corporate or personal income tax considerations in the model.
We shouldn't either, because this is supposed to be a base thing off of which people can plan, and they put all those other pieces in. This is about the maple product production, the cost of producing maple products, not what you do with your personal taxes afterwards. Yep.
We're all farmers, so farmers don't make money.
We should.
I was going to say, I've seen, no, I'm not.
Anyways, Neil, I know you put a lot of work in this with your whole group and everything else. Job well done. Very well done.
Thank you very much. It was a lot of fun to do. We had a good group and, good representation from a broad range of producers, and everybody was really open with information. I was frankly surprised, how forthcoming people were. And, people had access to other people who were helping as well. So I have a lot of faith in the numbers that we've put up here as in the examples. You know, those are real numbers from real operations. So if you want to compare yourself, that's you know, a place you can start.
Is there anybody on the line from OMSPA this evening?
No, I didn't see anybody.
No.
Okay.
So I got a question. I've seen a couple of the guys from. So I've got David. What do you think, David? Looked okay? Does that match what you have in mind there? Like what you did tonight? Does it look good or?
Yeah, I'm gonna have a look at it.
Yeah, same here. I'm gonna play with it right soon as we're done here. I'm a numbers guy like you, and you know, I like numbers.
If you find a number that doesn't make sense, be sure to let me know.
Will do. I'm going to do that.
Okay. Any more questions or comments? Or I think we've covered it pretty well.
Hey, Bill.
Bill, did you have a question?
I'd just like to say I've worked in accounting on and off for the past 35 years. Working through the model, it's very easy to use, very well organized. I give them together a lot of credit.
Thank you.
It should be easy for any producer to put the numbers in. I mean, go to your, there might be some difficulty. A lot of down here are mixed farmers. They do syrup along with their other farming and tend to bury their costs. Might make it a little more difficult, but for a straight sugar producer, very easy to use.
Well, and you know, that may be in a future version, you know, as part of the instructions, because you know, same with blending labor costs, and you know, sometimes people are just going to have to proportion a number and make their best guess. Yeah, like often, as you know, as in accounting, it's not black or white. It's the best shade of gray you think you can get away with. So.